And again, the call is a right to buy. It's like an insurance. You pay a premium, you have a right. If it is a call, it's the right to buy. And it has an expiry, and it has a coverage level, which in our metals is the strike price for any of the metals. When you buy a call and you spend monies, and it's very expensive, just to give you an idea, a call for 1 month on the alley, it's around $100. It's a lot of money. Is of course because you are willing to protect a risk, okay? And what is the risk? That the price is going up, okay? And in this example, it's because you are a transformer, a consumer who sells the secondary alloy on a fixed price basis. So, and at the same time, the primary aluminum we need has a floating price, so we need to cover it. So there are two alternatives. Either I hedge it with future, and in this example, nowadays the curve of the aluminum is flat, let's say around 2,600, okay? I buy it, boom, or I buy a call with a strike of 2,600, or perhaps if I want to pay a lower premium, a higher strike price, which would be I am ready to run part of the upside. So having said so, what would be the rationale of paying a premium when the futures are for free? And you are not a speculator. It's a completely different way of looking at. Throughout this explanation, I am refreshing our last episode because I want to have a refreshed view on the same topic before we jump into hedging with this. So, the idea of buying a call is the same as buying a future, which is getting a protection. Yeah. In one case, we pay a premium. There is a cost which is high. In the other case, there is no premium on the futures. There's no premium. So again, and you are a hedger, would be the rationale to pay $90 for a premium with a call when with the futures there is no cost? Is, in one hand, because I need and I want to be protected, which is the strike price, which protects me, again, a fluctuation upside. This is one. But the moment I decide to pay $90 for a premium is because I have a view. Because if I have no view, or I believe that the market is gonna go higher, I just buy futures, forget it. But if I have a view that the market may fall, and this is exactly the opposite reasoning as a speculator. Don't get confused. When you read books, every single book says the rationale of a call buyer is because he expects the market to go higher more than the premium, but in case he fails on his decision, his risk is limited to the premium. That's for a speculator, but we have exactly the opposite reasoning. Never forget that. Exactly the opposite reasoning. So what does it mean? I pay $90 because my view is that the markets are gonna go down more than $90, which is the premium paid, and at the same time I need to be protected. Okay? So the break even with the numbers we are using today will be the strike price 2,600 2,600 minus $90 the premium, okay, which is 2,510. If I believe that the market is going to go down more under the break even, I buy a call. And if I don't want to spend such a large amount of money, I'm convinced that the market is going to go down, I can choose a higher strike price and pay less premium. But I need to calculate with my cost which is the break-even in case I need to exercise it. Because in that case, the exercise will be, my cost will be the strike price plus the premium paid. If it is another money, 2,600, it's going to be 2,690, and my costs should be ready to afford that amount of money. Otherwise, I buy a future. So having said that, you don't necessarily need to do the whole transaction in calls or in forwards, futures. You can do 90% with futures, 10% with calls. Why is that? Because you are introducing a little speculative factor through that. So remember, any hedger who uses calls or puts to be hedged is speculating a little bit because he's investing monies. Different is the case with the collar, which is a different strategy we are going to analyze in the future. But if you buy calls, or if you bought puts to protect the downside, or calls to protect the upside, is because you have a little speculative view. I would say not a little, a speculative view. And is that correct? Of course, that's correct. We spend our life speculating. So what shall I do? Buy calls or buy futures? One is pretty much depending on your costs, and two, pretty much depending on your view. And of course, on the third place, depending whether you want to spend monies with a premium. Okay? And I have explained the rationale behind that. And there is another situation, which is I must buy calls. I have no choice because I have no monies for the initials or for the evaluation, which is the guarantee on the transaction. In that case, I would be forced to hedge with calls. So I hope this completes a refreshed view on using the call for hedging, and see you next time. Bye-bye.